Good evening, everyone. Just trying to give everyone else a chance to get on from the start. So bear with us. I see everyone's popping in one by one. So let's give them a chance to come in and we'll begin in just a few, okay? Good evening, Kevin. How are you doing today? I see everyone's coming in slowly but surely. Remember, guys, if you have any questions, you can always drop it in the chat box. We have quite a number of you here right now. Just giving you guys a chance to get in. Let's give them maybe 3 more minutes, if so much. All right, guys. So we're 5 minutes past the hour. Welcome, welcome, everyone. Welcome to this evening's class. How are you guys doing today? Hope everyone's doing well. This evening we'll be doing how to trade harmonic patterns using the trade finder. Before we jump into this evening's class, do you guys use the trade finder? How many of you have used the trade finder? Just give me a yes if you've used the trade finder. Let me know if you know anything about harmonic patterns. I see Mark says yes. Zena says yes. Reginald says yes. Kevin says no. Okay, okay, okay. So we have a few of you who have either used the trade finder or are familiar with harmonic patterns. Wonderful. All right, so let's try to jump into this evening's class. All right, so everyone can see my screen, right? All right, so everyone can see my screen. Great. Okay. So what is a harmonic pattern? Just got some information here that I'd like to share with you guys, and then we'll take it to our chart. What is a harmonic pattern? The first harmonic pattern was discovered by H.M. Gartley in 1935. And current publicly known harmonic patterns come from the work of Bryce Gilmore and Scott Carney. A harmonic pattern is constructed when geometry and Fibonacci numbers are combined at points of Fibonacci confluence. It is those points of confluence that traders would take some profit out the market, add or enter a position. Now, Ralph Nelson Elliott did not see harmonic patterns. From my understanding, he did not see harmonic patterns. H.M. Gartley saw the first harmonic pattern. Then Bryce Gilmore and Scott Carney discovered some others. But no one saw harmonics and wave theory worked together. Okay? Now, Elliott gave us Fibonacci measurements for waves, and Scott Carney applied Fibonacci to harmonics. I discovered that Fibonacci works best with harmonics, and harmonics are a combination of wave patterns that predict the next wave cycle. Now, harmonic patterns are one of the most valuable techniques used in the financial markets, but is also the most misunderstood, as most traders don't understand what areas of Fibonacci confluence mean. They don't know if to buy or sell, but as we move forward, it will become clear what actions should be taken. Now, what actions should I take when a harmonic pattern is located? When a harmonic pattern is located, a trader should know if to buy or sell based on what greater pattern the harmonic pattern falls within. Now, this is where you would look at the harmonic pattern and then you would overlay the Elliott wave theory over it. Now, in the diagram in our next slide, the Gartley and cipher pattern are featured. When we go to our chart, we will clearly see the harmonic patterns completed inside a flat pattern. So once a trader understands a flat pattern which falls within the Elliott wave theory, he or she would have confirmation to buy or sell off these harmonic patterns. Okay, now look at our next slide. Here we have the Gartley pattern, which is the blue one, and we have the cipher pattern, which is the pink one. Okay, look, and this is recent information. I did not give you information from way in the past. I prepared this information fresh. So this is fresh information. So here you can see this Gartley pattern. I took this from the Trade Finder. You can see this Gartley pattern and you can see this cipher pattern over here in pink, right? Look at the way how they react to price action. Now let's go to our chart. All right, this is the information right here, the same patterns from our chart, from our slide. I'm just gonna compress the price action a bit. So look at this. Look at all this information. This is our price action that we're getting here, right? And you can see that we have a downtrend, right? So we have a downtrend and all of this is very choppy. So all of this is correction, right? So I look at all of this here as correction. There may be a lot of corrective patterns forming here. For example, one of which I found is potentially a wedge formation, right? So I saw one that looks like this. I saw this. One second. Let's try to get this as accurate as possible. Good. I saw this potential pattern. I don't know how many of you guys noticed it, but I saw this as a potential wedge to the downside. It could even come like this. I think this way is better. Yeah, so I saw this as a potential wedge where we have 1, 2, 3, and this is potentially 4, 5, and we go down, right? So this should be taking us to the downside, okay? So this could also be considered a diagonal formation. If you want to look at it from the diagonal point of view, this could be the diagonal formation, not a wedge. The wedge is more of a traditional name for it. So this could be a diagonal, which could be a leading diagonal, taking price to the downside. It could also end up becoming a ending diagonal, taking the price back to the upside. So this is a type of pattern that you need to be very careful with. Now, inside of this type of pattern formation, if I just remove these lines, don't want to confuse you too much. So I'll remove these lines and let's make this bigger. If we look at this as our pulse, right? So this is our pulse. So we have a pulse. And after the pulse comes the correction. Now, we need to understand, we need to identify our lows. So if this is our low, right? So if this is our low and we identify our high, This is our high, right? We need to understand how these patterns work, right? So we have a pulse up. So we have a pulse down, a pulse up. We have a 1, 2, 3 down. So when we get pulse, we get 1, 2, 3 correction, we will expect the next move to be a pulse, right? Especially when we retest the low. So we will expect the next move to be a pulse. Here we did get a pulse, right? But we need to understand that price is not always simple and straightforward. So if we did trade this harmonic pattern here, this Gartley, for the move up, we would have been able to get some good profits out of it, right? So let's make this bigger. We would have been able to get some good profits out of it. Now, I like to pay attention to market open times, market break times, and session close times, right? Or market close times. So if I'm looking to get involved in this pattern, I'll be looking at when there's going to be enough volatility in the market to get me to where I want to go. And volatility in the market comes when the session is open. Okay. So let's see here. Okay, we're on Eastern Standard Time here, and I'm looking at, this is approximately 5 a.m. Eastern Standard, right? So this is lunchtime in the European session. Now, around lunchtime in the European session, as you can see here, the market was coming down, and it's lunchtime. We have a, let's see here, we have a green candle, and then price starts to move back to the upside. So this tells me that potentially the buyers are coming in at this point. And if I look at the way this price action is constructed, I have pulse, then I have 1, 2, 3. So this tells me that I can get another wave to the upside. That would be very likely that I get another wave to the upside, right? And this would have been the first part of that wave to the upside. However, the market makers, they like to get tricky at times. So what they did was they gave us the first push to the upside, and they corrected the entire move. Now, with them correcting the entire move, we need to understand that this 1, 2, 3 could still be our corrective impulsive wave followed by a corrective structure. And that's what's happening here. So we have another flat pattern inside here, right? So if I'm to just remove these lines for now, and we have another flat pattern forming here, right? So that's the high, and this is the low, and there you go. The price goes flat in this area. You have pulse, you have correction, you have another move up. So this is 1, 2, 3 here. As you can see, it's bouncing inside of this range. So that is a flat, right? This flat is an expanded flat. It broke the bottom, it broke the top. So that's an expanded flat. And then we're coming back to the downside, right? So we're coming back to the downside. So this first move, I would look at and say that this is this wave, right? So this could be potentially this wave. It does not have to come looking exactly like how this one looks like a very distinct 3-wave move. It could come in a slightly different shape, but I will expect that move, right? So let me just measure this entire wave, and I bring it over here. So this is the type of wave that I will expect, right? I'll expect this wave to the downside. Now, you can see that we're getting a correction. And if I'm to use market geometry again, and I'm using market geometry to try to catch this measurement here, there is a possibility that this could be a long wave, and then we get a correction here, and we get a short wave. to make this distance, right? So it does not have to be this length to come back to complete this wave. Now, if we measure this one over here, this is the first pulse. And, oops, and this is how it completed, right? So you can see this is a measured move. You got one wave, you got the same distance coming here, right? So that's a measured move. Pretty much exactly the same, okay? Now, it doesn't mean that because of this one was a measured move, this one will be the same, because we have alternation. For those who saw that class on alternative waves, you would understand that both waves don't have to be exactly the same. So this one could come in 5 waves, 1, 2, 3, 4, 5. This one could be longer. This one could be shorter, okay? So we need to wait to see what's going to play out at this point. But if you look at this cipher pattern here, this cipher pattern took on, you got the first impulse up, then you got the corrective wave down, then you got the next wave up. So this is 1, 2, 3, then we get the next pulse down, okay? If this price action becomes more complex, what can happen is this could be an internal 1, 2, 3 like this. See this? 1, 2, 3, and you get another wave back to the upside. Another wave like this. Back to the upside like that. So that is a possibility. Then, after getting that, then we get this wave to the downside, right? So that is also a possibility. So it is good not to get too excited, not to just jump into the market. You need to make sure that you wait for confirmation. And something I see a lot of traders do is they like trading overnight. And when I say trading overnight, I mean like you're getting into positions off session. So if you're trading euro dollar, US dollar pair, and you're getting into trades at a time like now, I would not say that that is the wisest decision, because in the corrective cycle, that is where the market evolves. And you don't want to find yourself in a situation where the market's evolving and creating some sort of different or strange corrective formation that you may not understand, okay? Because the structures can become very complex. Now, with this harmonic pattern forming at this area, it would have given you a hint that there is potentially a move down coming. So in a situation like that, you would have to wait, let this harmonic pattern complete, and look at the time. We do not want to get into the market at times when we are not necessarily going to get the volatility that we need. And also, the market shifts momentum at certain times. So if we understand the times that the market's going to shift momentum and combine that with the potential reversal zone of the harmonic pattern, we could find ourselves with a more accurate entry. Okay, so if we look at the times here, we have, let's make this a little bigger. This hit the reversal zone at approximately, this is 7 to 8 o'clock. So this is the 7 to 8 o'clock candle. And if we took this trade to the downside at this time, it would be a good trade. We would be able to get to our profit target, because our profit target in this case would either be a Fibonacci level, which is the 382 or 50% or 61.8%. So we would have been able to get to our profit target here, right? Then the price bounced back to the upside. Now, this entire piece is a correction. From this point to this point is a correction, and this is the final wave up. So this is going 1, 2, 3. 1, 2, 3, and then we get a 5-wave move, or this may be a 3-wave move to the upside. Okay, this would complete a corrective move up, and that's why we have this next move coming down. Okay, so with this completing its move down here, pushing back to this level, with us having this flat formation here, this flat, once the price hits the top of the flat, we will expect it to turn again to the downside. Okay, now, because a lot of us may not be able to identify these flat patterns quickly, we may be left in the dust. So if you would focus on being able to identify your pattern formations, it would help you to trade harmonics. Harmonic patterns fall inside of wave structures. Okay, so if you would take some time, understand the different wave structures, the different pattern formations, so that whenever a harmonic pattern is formed, what you need to do is first look to see what pattern, what higher degree pattern this harmonic pattern falls within. Okay, because the market is connected. The market is not just about one method, it's about many methods. So when these methods combine, we can find areas of confluence. And the potential reversal zone is just one type of confluence. The more areas of confluence that you can locate, the stronger your trade opportunity becomes. Okay? Any questions so far? Anything you guys are not too clear on? Just giving you guys a chance to submit any questions or any queries in the Q&A, in the chat box, sorry. Go ahead, drop your questions if you have any. I'll come back to the chat box. All right, so someone give me an instrument and let's take a look. Let's see if we find ourselves some harmonic patterns there, and let's see if we can see what the outcome would be. So just give me a pair, any pair that you'd like me to take a look at. Let's try to stick with pairs from the European and US session, okay? Okay, I see someone says pound JPY. Let's stick with pairs from the Euro session or London session and US session. But if you'd like me to take a look at pound JPY, I might as well. So let's see. Okay, I'm not getting any data for this one. Let's see if I can find something down here. One second. Let's see if we can find anything for pound. Okay, we don't have any harmonics down here for pound JPY. Actually, I don't have the pound JPY on my scanner over here. I see Mark says gold. I don't have gold here either, but let me see if I can put that on just for you. Let's see here. Okay, I'll take off all of these. Oops. So many instruments we can scan. All right, let's see if I find anything for gold. Here we go. We have some here. So here we are. So gold is showing us that it has a potential bat, and it also has a potential Gartley. Okay, they're all coming in the same area. As you can see here, they're both in the same area. Let's go to the chart. Let's see here. All right. Okay. So that pattern was most likely from, okay, this one shows it's copper. I'm on the wrong chart. My bad. Why is that copper? Oh, okay. Don't know why I'm on copper, but this is the copper chart. But this is the gold chart here. Okay. So here we have so many patterns on gold. We have quite a lot. And if we just simply just compress this data as much as you can, just to have a better view of what's going on, right? I can see we have a strong move up. It looks like a gap, but it's a strong move down. Then we have a corrective looking move to the upside. So let's see what's happening over here. Right, so we have this looking like 1, 2, 3 to the upside. And if this is 1, 2, 3, and we have price action coming down, I'm going to look at this as my impulsive corrective move to the downside. And since that is my impulsive corrective move to the downside, let me see if I can take off some of these patterns here. Okay, I need that one. I don't need this one. So this one gave us a little bounce over here. Don't need that one. It's a double top. This one is not too bad either, but I'll take it off. Okay, so I left on the bat and I left on the crab. Okay, so there we have the crab and we also have a bat pattern. So this is the bat pattern and this is the crab pattern. I would prefer to look at the bat pattern, sorry. So if I'm to look at the bat pattern, and the reason why I prefer to look at this one is simply because this one is coming from a low to a high. It goes down to a low, back to a high, and then it goes to a low. So I look at a situation like this as a perfect pattern, right? So I look at this as a perfect pattern. And because I know this is 1, this is 2, this is 3, I would say this is a corrective move to the upside. We can look at this as impulsive corrective. And then I'm going to expect a move down. So remember, price moves in 3 waves and 5 waves. So if we had 3 waves up, we're now getting a strong move down. So we can see that between A, B, C, D, this is a strong move to the downside, right? As much as it's corrective, it is a strong move. So after this move, I would expect a 3-wave correction. And if you look at this price action, what do you see? This is a pulse, this is correction. So we have this as 1, 1, 2, 3. We got a pullback here, another push up. So this is 1, 2, 3 waves, right? If you're to label this, this is going to be W, X, and Y like that. And this makes this 1, 2, 3. So we have a 3-wave move up. Now, since we got this strong move down, we're going to expect a correction. And why would we enter on this setup? I would enter on this setup based on time. So this red bar is between, it opens at 7, it closes at 8 o'clock, right? At what time does volatility come into the market? Volatility comes into the market at 8 a.m. Eastern Standard. Okay, so that's in the US session. Volatility comes into the market at 8 a.m. Eastern Standard. It comes into the market at 2 a.m. Eastern Standard. It comes into the market as well at between 5 and 6 a.m. Eastern Standard as well. In the US session, it's between 8 and 9 a.m. Eastern Standard. In the European session, you also have between 2 and 3 a.m. Eastern Standard. That's London and European Open, right? So if you understand the times when volatility comes into the market and that you connect the time to where your pattern completes, it gives you another area of confluence. So you're using time and you're using harmonics, and then you can use the higher degree Elliott wave formations. So on the higher degree of Elliott, we have 1, 2, 3. Price pulls back. We will expect a correction. Okay, so you'll expect a correction. This would be the corrective wave. And so if you entered here at that time, which is around 8 o'clock, between 8, 9 o'clock or so, this would give you an opportunity to catch the volatility to the upside. Let's see when this volatility ends. So this goes until generally I like getting out of the market by 12 p.m. Eastern Standard. So once I catch this move to the upside, I like day trading, right? So I'm more of a day trader than a swing trader. So once I catch this move to the upside, I'm looking for my area to exit. And when we trade harmonics, our profit targets are always based on Fibonacci. And we measure them in different ways. We measure from the C leg to the completion of the D leg. So you can see here, we have, normally we set profit targets at profit target 1 at 38.2, profit target 2 at 50%, profit target 3 is usually at 61.8. Okay? Or 618. Some of you may know it as 618. Okay? We also set profit targets from the A to the D, and same levels we look at 38.2, we look at 50%, we look at 618, right? So as you can see, we would have been able to hit these profit targets, whichever one you had set, and be done with the setup. Something else we need to pay attention to when it relates to harmonic patterns. A lot of harmonic patterns form corrections, though they also form impulsive waves. But the way in which the market moves would cause a lot of harmonic patterns to create corrective formations. So when you're trading harmonics, you need to be very careful, because you may get a reversal zone, it comes in at the right time, it falls nicely within the Elliott wave theory, but do not set in your mind that when you get a harmonic reversal zone that it's going to take the price to the moon. That does not happen. In a lot of cases, that will not happen. So when you trade a harmonic pattern, you need to prepare yourself to take your profit out. Okay? Remember that. You need to make sure that you take your profit out the market, because the price in a lot of cases will come back against you. Okay, like you can see here, You did get that nice aggressive move to the upside, but here is the price coming back against you again. Why is the price coming back against you? Because this would be an impulse. This is one wave of your correction. You have another wave coming to the downside, and we're going to get another wave to the upside. So this is most likely going to form a flat pattern in this area, right? So remember, you need to always mark your lows and mark your highs, because these are the areas where the price is going to create flat patterns. And flat patterns are very, very common. So this is what I'm going to expect. I'm going to expect this one to come back, give you something like this before it goes down for one more. Okay. Now, after it goes down for one more, this one could continue moving to the downside. It could continue moving down, or it could make another move up from here. Oops. Let's erase some of this. Yeah, so it could make another move to the upside, like this. All right, so you got to make sure that you take your profit out the market when you come back to this low. So once you come back to this area here, you need to start looking for a reason to exit. Okay. And remember, I like taking the approach of trading wave by wave. I don't like staying in the market for too long. I don't like taking trades overnight. I like getting into the market when I have a high probability of success. Okay. And having a high probability of success means that I need to get into the market at the market open, at the session break, which is lunchtime, around the session close, when we're rolling over into the next session. So you need to make sure that you take your entries at the right times. If you look at this, we have another potential flat pattern over here, right? So this comes, it completes around this low, then you start looking for a reason to buy this back to the upside. Okay, so any other instrument you guys would like me to take a look at? Anyone else? Any other instrument? Okay, Kevin says USD JPY. Okay, that's another one where we're looking at the US dollar and the Japanese yen. I would prefer if we look at instruments where we look at instruments from the European session and US session to create the pair. But let's look at that. USD Japanese yen. Okay, let's see. All right, good. So here we have some potential patterns forming. We have some potential patterns forming here. Let me just try to take the ones that are not complete off. Let's look at these two. All right, let's compress the price a bit, just so we can have a better idea of what's going on. Right? Look at this. I would look at that and I'll say that is my high. This is my low. Right? So this is my high. This is my low. Then I came back to my high, broke my high. If we understand the flat pattern formations, once you make a high, you make a low, and you come back to break the previous high, you're most likely going to have a flat pattern formation. So we will expect this leg to come back over here. So if I'm to measure that, because as you know, I like using market geometry. If I'm to measure that, bring it over here, I'm going to expect the price to come back to this level, right? How is the price going to get back to this level? Now let's only focus on this leg. If we're only focusing on this leg, I need to do the same thing that I did earlier. I need to identify my low. This is my low for this wave that is coming down, right? So this is my impulse. It ends here. So this is my low. And then I need to identify my high. All right, I'll draw this in fresh. Identify my high. This is my high. Good. So what am I looking at? I'm looking at one wave up. So this would be my corrective impulse. This is my 1, 2, 3 down, and my next impulse pushing to the upside, right? So I'm going to use market geometry, measure this wave, just to give me an idea where my wave up should end. And I'll put this where this wave, right? So my wave should be ending in this area. It should be ending in this area, right? Now, we're getting this harmonic pattern at this time. This harmonic pattern should be pushing the price down. Let us see what wave construction we have. We have one, let's see, 1, 2, 3. All right, so we got 1, 2, 3 push. So that's 3 waves up, or this one could actually be WXYXZ, right? So this is one correction here. So this is 1, 2, this is 3, this is 4, and this is potentially 5, right? So we have 5 waves up. So because we have 5 waves up, this move to the upside could be complete. And we also have a measured move, right? So this measured move tells me that this wave should potentially complete itself in this area. Now, what did I get next? I have price coming down in 5 waves, pushing up, pushing down again. Did it break the top? No, it didn't quite break the top. It came close, but did not break the top. So this could still be looked at as my first wave down, and this is potentially my correction. It looks a bit sharp, but it's potentially my correction up. And then I get a strong move down, and I'm getting another correction here. So if I'm trading this according to harmonic patterns where we set our profit targets, this would be profit target 1, this would be profit target 2, and this would be profit target 3 right here at 618, right? So I'll expect price to come down. And what I can do here as well is mark my low. So that's my low. And this is potentially the high, right? So this is potentially what's happening here. So what I'm going to look for is, you know, this is 1, 2, 3. We get 1, 2, 3. We get 1, 2, 3, or 4, 5 like that. And then we come back to the downside. So I'm looking for something like that. Okay, so I'll look for a move like this. I'll be looking to get involved at the highs. These are the areas where I'm looking to get involved, right? The high to go short. All right. And remember, you need to pay attention to time as well. So you pay attention to time. So this is US dollar, Japanese yen. I'm looking at getting involved at the times when there is the most volatility in the market. So I'd most likely be looking forward to getting involved in this trade around 7, 8 o'clock. So right around somewhere here, this is where I'd be looking to get involved with this trade. And this, based on my forecast, this is around the approximate time where this pattern could complete itself, somewhere around 8 o'clock or so, and give me a nice move to the downside. Okay. Any other questions, guys? Any questions for me? So the main aim here is that you guys understand your Elliott wave patterns. Once you understand your Elliott wave patterns, you will be able to trade harmonics in a much better way. When it comes to trading harmonics or trading any method, you need to also understand the times that it's best to get involved in the market. You need to get involved in the market when the market has volatility in it. And volatility comes in at the session open, the session break, the session close. Okay? Remember, you're trading pairs. So since you're trading pairs, you're going to need to look at the session close of the first pair, the first instrument that you're looking at. So if you're looking at euro dollar, US dollar, you need to look at the session close of the euro, right? Because you're going to be getting some sort of volatility at that time. If the euro traders are going home and getting out of their positions, the market's going to move. Okay? Okay, guys. Thank you so much for your time. This will bring us to the end of this evening's class, unless you have any other questions. If you have any other questions, please go ahead, drop them in the Q&A box. I'll be more than happy to offer any clarification. All right, I see thank yous. You're most welcome, most welcome. All right, guys. Thank you so much for your time. I'll see you guys on our next class. Bye-bye for now. Yes, this class will be recorded as well and will be made available to you guys. Okay, so the recordings will be made available soon. They will be in your back office. All the recordings will be made available in your back office. I see Mark says, which waves repeat measurements? You're going to have your A wave and your C wave. If you're looking at a pattern as ABC, which is, let me just do a little scribble here. If you're looking at this as A, oops. If you're looking at this as A, B, C, right? So this would be your A wave. And this would be your B wave. Oops. And this would be your C wave here, right? So your A wave and your C wave generally would be equal in length. Then if you're looking at this as 1, 2, 3, 4, 5, you're going to look at your wave 1 and your wave 5. Generally, they're equal in length, right? But you can also project your wave 1 to get a nice profit target on your wave 3. Though wave 3 could be longer, but you're only going to go for the measured move because you know that you should at least get the measured move on wave 3. Okay, so this way you know for sure you're going to get a decent profit target out of it. So I like using market geometry because market geometry is very accurate. It's very helpful when it comes to setting profit targets. Or even when it comes to finding entries, market geometry is very useful in that way as well. All right, Mark says, got it. You're most welcome. Okay, guys, bye-bye for now. I'll see you on our next class. Bye-bye.